It is my belief that things don't just happen by chance, but by proper planning. Do you have a retirement plan or simply have an investment portfolio that can use some fresh ideas? Hi, my name is Mike Ecker, and my podcast is called Investment Choices. In my podcast, I will be speaking with professionals who will be discussing alternative investment ideas that may be a good fit for your financial plans. There is more to investing than just stocks, bonds, and mutual funds. Hi, everybody. This is Mike Ecker. Welcome to my podcast, Investment Choices. With me today, I have an exciting guest, Ben Carmona, whose 13 years experience of being my friend in the field of 1031s and alternative investments is unbelievable. He's done marketing, research, all the different aspects of a 1031. I'm not trying to give you the basic points of a 1031. You can go online and get that anywhere you want. We're going to have a conversation, Ben and I, about 1031s, the IRS, the alternative between doing a 1031 yourself and what we call a DST, or Delaware Statutory Trust. So, Ben, I guess my first question to you, the 1031 Irs Code. Give me a little background on that so we know that what people are looking at when they look at the 1031.
Yeah, the Irs Code has been around for almost 100 years now. So it's one of the most longest standing, impactful tax vehicle or tax code in the U.S.
Yeah, basically, what does it say to an investor in the 1031 code?
Got it. So the 1031 Irs Code 1031 basically allows you or investment property owners to sell their appreciated real estate and defer all of the taxes as long as they use those proceeds to invest in other investment property.
Does it have to be the same property or the like kind of property?
Right, and like kind is a term you'll see, and it's very loosely used. So it's basically all investment property for investment property. You can go from an apartment building to land to a retail center. Anything that's held for productive use in the business or as an investment will qualify or satisfy a 1031 exchange.
Okay, there's really two ways, as I understand it, to do a 1031. The 1031 you can do actually by yourself. So somebody can actually buy and sell their own property. Is that one way to do 1031? How is that beneficial to them, or how does that work?
Yeah, I mean, traditionally and still today, the most common way of completing an exchange is doing it on your own, right, with the help of a realtor or broker most times. But you're responsible for going out and finding suitable replacement property, doing the underwriting, the due diligence, getting the property manager, getting your financing. And that's the traditional way, still the most common way today. And as I'm sure we'll discuss, the traditional way isn't easy today. We're out of equilibrium. And there's some real challenges with completing a traditional exchange. And there's this other option, the Delaware Statutory Trust, which we'll discuss, and I'll let you lead the way.
Okay, good. On the 1031, where they do it themselves, there's a lot of moving parts. You have your CPA, you got to do the annual filing, and all this has to be done. So you're trying to coordinate between everybody. With the DST, it kind of takes it away. So what is a Delaware Statutory Trust, or a DST?
Right. So, the traditional or the old school to now new school, the Delaware Statutory Trust is a phenomenal vehicle, especially in today's environment, given some of the challenges of completing your traditional exchange. But a DST essentially is a turnkey passive replacement property solution for investors. That essentially there's one trustee that manages the trust, the Delaware Statutory Trust, on behalf of up to 499 beneficial or fractionalized owners. And what happens is we are sponsors. There are a variety of sponsors out there that go out and buy institutional quality real estate with their balance sheet, with their relationships, with their expertise and their financing capabilities, and create a turnkey, again, replacement property solution for investors, eliminating all of those headaches of completing an exchange on your own.
So in other words, all the paperwork and everything's done. I always look at it as like you don't have to change the toilet paper and you don't have to clean the toilets. It's done for you from start to finish. So
That's correct.
basically, that's what my mother used to say. With the DST and the different properties, what about the accounting that's involved, the legal involved? Do the individual investors in a DST own the property themselves, the one they're purchasing?
Yes, absolutely. So first, the taxes, the paperwork, again, all the due diligence that you would have to do traditionally if you were buying your own property, all the financing, everything is done through the sponsor. So it's off your back. And yes, the owners are owners of the investors are fractionalized owners of the real estate, direct owners of the real estate. They just own 1 or 2 or 5% of the underlying trust and whatever real estate's within that trust. But it does constitute real property ownership. And this was determined, through Irs Code 2014-86. It's where the IRS came out and basically said this type of fractionalized ownership does constitute real property ownership and therefore can satisfy an exchange.
So basically, a DST, if I understand you correctly, is an identified property where you don't have to go out and look. Can you invest in more than one DST, or is it just one where you have to invest?
Yeah, no, that's the key. The beautiful thing about a DST is that the minimums are most times $100,000, and so it gives you the flexibility to, in theory, reduce risk and diversify across a variety of different asset types and geographic locations. So if you have one property that you're selling for $1 million, you could take that 1 million and, in theory, again, spread it across 10 different vehicles, reduce risk, and that's really the name of the game today. Reducing
the risk, and also you don't have to worry about the paperwork. A check is sent to you.
Of course.
How is the distributions handled? Is it usually on a monthly basis that the DST gives it, or quarterly? How do they usually work on distributions? And what are we looking at? I don't want to get into averages because they're all different, but how are distributions handled in a DST?
Sure. We distributions are paid on a monthly basis. So as we collect rents as the manager, we then reissue those rents to our investors. So it's mailbox money. And again, it's a passive income stream and allows investors or owners of investment property to get away from the active management aspect of it, the toilets, trash, tenants, and really take that passive role.
What is the time frame for a DST? In other words, you've made this purchase, you've taken your 1031, and again, I want to specify that you don't really take the funds. It's done through an intermediary, which we would discuss in another podcast. But for all intents and purposes, the money is given to an intermediary. The intermediary then posts the money to the investment of the choosing of that investor. Is that correct?
That is correct. Yes, the equity flows upon closing, goes to the qualified intermediary, and at that point, that's where you're identifying your potential replacement property solutions. And once you've identified, the QI will release funds to those properties or property of your choosing. And that's another great thing about a DST is that because the sponsors have already acquired these assets, it's a very easy or simple and easy, timely closing process. I always joke, if you can complete your paperwork quickly, you can be closed in a DST and earning or accruing distributions within 48 hours. And if you just think about that compared to a traditional exchange that could take far longer than that, and that doesn't offer you that surety of close, which is a major problem today, that's where the DST really shines.
And there is a time frame that you have once you've sold a property to identify and go into something else. Is that correct?
That's correct. So the rule states, or the Irs Code or the guidelines require that you identify potential replacement property within 45 days and close on the replacement property within 180 days. So you are bound to guidelines. And really, the biggest challenge is that 45-day identification period, right? Most people can close in 180, but again, I just want to reiterate, to find suitable replacement property and do the underwriting, due diligence, get your financing, get your property manager, and then also you have to win the deal. And that's the big challenge today, is that it's easy to sell. It's not easy to close because there's so many buyers chasing such little inventory.
Right.
And so to make that all happen within 45 days is a challenge.
What happens if somebody does an individual 1031? They've located a property, they've identified it, they get to the table, the closing doesn't go the way it's supposed to, and all of a sudden you're beyond those time limits that you just mentioned. What happens to the recording of that 1031? What happens then?
Yeah, and that's a big issue today. So within that 45-day period, you can change your identifications as many times as you like. But once that 45-day period lapses, your only options are the properties that you have identified. So if the properties you've identified fall out of escrow, or something doesn't go right, or somebody comes in last minute and offers 20% more in cash, and you lose the deal, you're out of luck and you're stuck paying taxes.
So in other words, you got to pay taxes on the whole thing, and then the 1031 is not a vehicle that you can use any longer. So with a DST, you're going into an already identified property, and you don't have that problem with the window closing, or you're not going to closing.
That is correct. It's that it offers the surety of close, or in some cases, if it's not your first choice, it can be your backup plan. Right.
So in other words, somebody who's doing their own personal 1031 can identify a DST as a backup, possibly not use it, but have that in case something goes wrong with their first choice.
Yes, sir. Exactly right.
Okay. Let's take it a little further now. Somebody invests in a DST property, whatever it may be. What is the time frame or life of that DST? What is an investor looking at? If you have your own 1031, you want to sell it in 2 or 3 years, you can get out and sell it and go into another 1031. How does a DST work as far as that goes, as far as longevity of the investment?
Sure. Every DST has its own business plan or strategy. You have to look at it as a long-term investment. And between 4 and 6 or 5 to 7 years is traditionally what you'll see in a prospectus. It could be a little shorter. It could be a little longer. There is no defined exit strategy. And we have to point out that what you're giving up is control in a DST, but you're giving that control to an institutional caliber real estate manager, and it's their job to determine when the highest and best value is and when the right time is to sell. And again, you can't put a number on it. There's so many variables in real estate, but it's usually that 4 to 6, 5 to 7 year time frame.
How does the dividend work as far as stability? Is there a chance it can go up or go down? How does it work in the DST usually when there's an income level? It's, some DST will say X is the amount of interest that you're going to get. And is that a stable X, or is there a possibility of higher or lower during that time period?
Mm-hmm. Yeah, I'll start by saying that these are vehicles that are built. They're opportunistic in nature. They cater to investors that are truly looking, to go from active to passive and collect a monthly distribution, right? So you're not going to hit home runs, but they are geared toward providing stable, predictable, durable income. Now, can the distribution go up or down? Of course it can, right? This is real estate at the end of the day. There are risks in real estate, but again, given the nature of the investments and the investment managers that are managing and selecting and doing the underwriting here, it is the goal that the distributions remain stable and ideally increase over time as the real estate matures.
So let's take the positive first. At the end of X amount of years, and let's say it's a 5-6 year period of time, the investment is sold and there's a profit. Now you have your income and your profit. What happens to the tax consequences, and how does this affect the investor?
Right. So upon sale of When a DST sells, you'll be in the same position you are the day you sold your original investment property. So the funds will go to the qualified intermediary, and you will then have the choice of exchanging back into a DST, going and buying your own individual property direct, cashing out and paying tax, or a combination of the three. So all options are on the table, but the bottom line is selling a DST, you will still be you'll still be able to do a 1031 exchange and defer all those taxes going forward.
So in other words, the original investment, if it's increased and there's a profit, as long as you don't take that profit and go from one 1031 to another 1031, there's no tax consequence?
Correct.
How does that affect, let's say something happens, God forbid, to the owner of that investment and it goes to the heirs? How are the heirs have to pay taxes on that 1031? How does that work for the heirs?
Sure. That's a great question. And this is a great estate planning tool as well. And just like traditional real estate, upon death of the owner, there's a step up in basis. And of course, as determined or as guided through the estate plan, ownership is transferred to the beneficiary. So upon death of parents, the interests are passed on to the children at a stepped up basis. And all the taxes that had been deferred over the past many years are wiped out.
So in other words, they don't have to pay that tax consequences if they had that gain years ago from the original investor. Makes it kind of interesting. So in other words, as I understand it, you can go from one DST to another 1031 and not have any tax consequences for that. These are liquid investments or non-liquid investments, Ben?
Yeah, no, these are illiquid. Illiquid investments. Again, you're giving up control in terms of decision making, and so that's a problem for some investors, and this isn't a vehicle for them. But more and more investors today, as we see, demographics, the aging of the population, they don't want control, they don't want the decision making. But yes, it is an illiquid investment. They're for accredited investors only, and you have to view them as long-term investments.
How does the accounting work? What are the fees involved to the investor? In other words, it seems like it's complicated. At the end of the year, does my CPA have to file papers? What do I get as a DST? What's the burden on me as an investor, tax-wise, and doing the paperwork for taxes?
Mm-hmm. Sure. No, it's very, very simple. We issue what's referred to as a grantor letter. It looks like a K-1. It's a 2 or 3 page document that you hand to your CPA, and it's so that they can fill out your Schedule E. It's a very, very simple, easy to read document that you can just hand off to your CPA. There's no responsibility on your end to do any sort of reconciling of the numbers or the rents and the expenses. It's all done for you. Okay,
so it seems pretty compact as far as an investor goes, where they've actually, for the income and management, turns it over to you, and they're entitled to the dividend and any potential gain. Now, what happens if there's a loss at the end? Let's say, do the people that put the DST together, are they looking to liquidate at a loss? Are they going to hold it longer? Is the investment prolonged? What is the sale of this, and how long do they hold on to it?
Yeah, so what I'd say is, it's not, obviously, we don't want to sell at a loss. So unless our hand was forced in unforeseen circumstances, that's the only time we'd sell at a loss. If we're going through a rift in the economy, we would hold it longer, and as long as it was performing, we'd hold it until better times, and we'd sell at that point. That's what you're hiring these professionals to do, is to analyze the markets and add value over time and execute on a sale profitably when the time is right.
It's similar to if you have your own real estate investment, you're not going to liquidate in a low market. You're going to hold on to get a better price. Nobody's selling in the short market normally unless it's an emergency.
Well said.
So basically, the DST seems like a really good alternative to the do-it-yourself and there's really, no financial responsibility other than getting your, whatever that letter is called, or K1 or whatever.
Grantor letter, yeah.
Grantor letter, okay.
Yeah.
If I say it a few times, I'll get it right. But
Yeah.
no, that's really interesting. And this fits in all the timelines. How easy is it for an investor to speak to somebody about the DST to get some information on how it's doing? Is this where you can contact it? Do you have investor services? Can you speak to the owners of the DST who put it together? How accessible are these people?
Right, the communication ongoing. Absolutely, we're very accessible. At any time, you can pick up the phone. As you know, you can call me anytime, and I can give you updates. And we send out quarterly statements to investors, which outline the performance of the property. Is occupancy up? Is it down? What's going on in the market? We really give you a comprehensive overview of how the property or properties are operating on a quarterly basis. And then, distributions are sent monthly. You have statements that go out monthly. You can track it online. We're very accessible and transparent.
Okay. There are basic points to a 1031. In other words, timelines and things like that. I really didn't get into it in this podcast because I wanted to have Ben explain to you the alternatives. One last thing before we go, I just wanted to get an idea of some of the different types of investments that a 1031 could be in. Can it be in multifamily? Can it be in storage? What are some of the alternative investments you can go into if you're selling, a piece of land or something like that? Sure. What are the alternatives?
Yeah, and again, that's one of the real benefits of a DST is you have such a variety of options at your fingertips. You have multifamily, industrial, self-storage, single tenant, healthcare. You really have all the major food groups that you want access to, but don't have the amount of capital to buy these institutional quality properties. So again, just in summary, the DST is one of the most powerful vehicles today. It truly is a solution, given the aging of the population. Folks are looking for passive solutions. They don't know it exists. And to be able to take a lump sum of money, perhaps in one property, or investors are over concentrated in a certain state or a certain asset type, and reduce risk by diversifying in a variety of different asset types, as I mentioned, in different geographic locations, and in many cases, increase your income, increase tax efficiency, and we didn't touch on it, but remove the liability of the debt, right? Because these vehicles offer non-recourse financing.
And it's important. So, explain that a little.
Sure.
Yeah, explain.
So non-recourse debt essentially means you're benefiting from the leverage that you assume on these DSTs. And this is an important point. The DSTs, again, there's probably 40 at any given time. They all have different leverage points from 0% or all cash up to 85%, right? And you can blend those LTVs to get to where you need to be. But again, the debt that's in place is guaranteed by the sponsor, the trustee. You benefit as the investor from it, to satisfy your exchange, depreciation, interest deductions, but you're not actually liable for it. Whereas if you have a mortgage today, it's on your balance sheet. It's a liability for you.
Oh, I appreciate that. As I want to say, the DST is really an interesting alternative for 1031s if you're not doing it yourself. It takes away all the responsibility. Ben, I wanted to thank you. The podcast is Investment Choices other than stocks, bonds, and mutual funds. And I really appreciate spending time with me today, Ben. Thanks a lot. Have a great day.
Always a pleasure, Michael. Thank you.
Thank you. Bye-bye. Thank you for listening. Remember, things just don't happen when it comes to your financial future. This is Mike Ecker, and you've been listening to Investment Choices.